Hi, everybody. This is the investing teacher, high school science teacher, teaching others how to invest. This video, I just want to do more of a vlog type thought video, nothing big on strategies or anything. But recently went to Disney World, just got back last night. Pretty exhausting week. Took the kids out all week, went to 4 parks, spent a lot of money, but it was a really good time and very enjoyable. So during this trip, I decided to pretty much leave almost all of my brokerage accounts in cash. I did leave some of the cash secured puts that have later expiration dates out to end of December or even January. I just left those stay. I had a few credit spreads that are out to December, but nothing dramatic there. And a large amount of my funds were in cash for the week. And I just wanted to be able to see how just general thoughts of what option selling is during the week. And I didn't really check the stock market much last week. There was not much need to. It's not like I'm worried about managing positions and any of that stuff. So try to keep my mind fresh in order to see what I think about option selling. So while I was waiting in line for a lot of those Disney parks, it actually wasn't as bad as you think. Some of them were about 20, 30 minutes. I think the longest one we had was about 45 minutes. And we did most of the rides that we want. Had a lot of time to reflect on what I've been doing with option selling in the last few years. So one of the main ones that I noticed is I prefer the longer dated expirations in general. We do zero DTE at Data Traders, where we look at selling put credit spreads or call credit spreads or both with iron condors on SPX every day. And there are some pretty good results on it, but it could be very stressful. You have to look throughout the day. Is it going to be able to close at a certain target percent? Maybe it's very close to that target percent, but it didn't actually close yet. And then maybe it starts to go against you and you might stop out and whatnot. So a little bit stressful at times, especially if you're doing this with a large account size. I personally tend to do only a few contracts on that, where it's not going to be the end of the world if I get stopped out or if I take the profits. So I like the longer dated expirations in general because then you don't have to be worrying about that stuff, checking the market 3, 4 times every day and making sure that you're at the right levels and whatnot. I just personally like the longer dated, usually 30, 45 days out. And we typically look at very low deltas for a put or call. Put credit spreads, we typically look around zero point zero 0.06 to maybe zero point 0.1 delta in most cases, where if the market happens to drop or a certain position drops a bit in the first day, it's not necessarily the end of the world. The premiums might stay very close or just a few dollars against you. And you definitely have time to manage those and deal with any of the possible repercussions you might have if it starts to go against you. In the zero DTE, you really don't have the time to do that. It could go against you literally in minutes. You could see many times on SPX big red candles dropping down when you're in a put credit spread, and then suddenly you might stop out. But again, the longer dated expirations, you can still get very adequate returns. For my personal goals is about 2% a month. And if I reach 2% a month consistently, I'm going to more than reach the goals that I have for my eventual retirement. And a lot of these put credit spreads that are farther out in time, 30, 45 days, they typically will earn 4 to 5% on your money on those trades. Now, obviously, a few of them will stop out, but in the long term average, I think it's pretty reasonable to get at least 2% on your money doing these trades very consistently. Another thing I noticed while waiting in those long lines and reflecting was it's okay when you have an occasional stop out. If you do get a stop out and it stresses you out, where you're like, oh no, I just lost a lot of money, then one, you may not be worrying about the percentages. I think it's all a numbers game in the end. So if you're right 80, 85% of the time, which we usually are at data traders, you're going to more than offset those occasional stop outs where, let's say you're making 4 or 5% on 80% of your trades. If one out of every 5 trades or so, you're losing maybe 7, 8% at least, then not necessarily the end of the world in a lot of cases. You can still easily make your 2%. So I like to treat that as just a percentage game. Stop outs do happen, but it has to be pretty mechanical and psychological about it and not worry too much about those things when they do happen. I think for 2023, I'm going to be doing a video series on the psychology of dealing with your positions and how to handle when a position might go against you, looking at the overall portfolio and what to do when some of those don't necessarily go your way, and then looking at the long-term averages and whatnot. I did write a blog about some of my additional thoughts, and I left the link in the description down below. So if you go to thetatraders.blog, I did quite a few blog posts there. And if you'd like to know a little more additional thoughts, feel free to check on that blog. Anyway, I'm the investing teacher, high school science teacher, teaching others how to invest, and get right back to trading and do an occasional 0TZ DTE here and there. But my main focus will be the longer dated, 30, 45 days on futures and credit spreads and some cash secured puts. Have a great day, guys.